Welcome to the Cash Flow Champs podcast, the show where we demystify real estate investing so you have the tools you need to gain financial freedom through passive investments in real estate. And now your host, Cash Flow Champs managing partner, Prashant Kumar.
Hey guys, this is Prashant Kumar from Cash Flow Champs. Along with me, I have my partner, Paul Senior. We both are talking to Stefan T, who's a great friend of mine. We are talking on Cash Flow Champs real estate podcast. I cannot pronounce your last name. Stefan is still, even though I know you for so many years. Welcome to our show.
Thanks, Prashant. Thanks, Paul, as well. Pleasure to
thanks for coming on,
here.
Stefan. Really appreciate you being here.
So, Stefan, Paul, you know Stefan, but Stefan is a founder of Realty Quant, the company that brings data-driven and quantitative technique to the real estate industry. He's on a mission to add industry value through his education, investment, technology, and analytics. Stefan is a financial engineer. He turned into multifamily investor. He's an analytics speaker, and he is live webinar host also. He holds master's degree in financial engineering from Columbia, from New York. And during his finance career, he managed about $90 billion derivative portfolio jointly with other colleagues. He has spoken on multiple podcasts, multiple webinars. He hosts his own podcast. He has been on Best Ever Real Estate Show. He has been on, Cash Flow Champs Real Estate Summit also. And he hosts his podcast, Finance Meets Real Estate. So he's out there in the industry, and today we have an opportunity to talk to him. We want to understand what he does, what is unique that you, Stefan, do that others don't do, because how syndicators are or how passive investors are, and they are typically at a surface level, they try to underwrite the deal. But what you do is very unique. I want to understand from you, what is that do you do, how it makes unique value proposition for others. So tell me a little bit more about you, Stefan.
Yes, that's a great question. Thanks, Prashant. So what I do is data-driven real estate investing. That's basically what I do in one phrase, so to say. And so what data-driven real estate investing is I would say maybe 6 pillars. So one is kind of pulling on market, and on market's a little bit taboo in real estate because the best deals are off market, but actually pulling all the on market data as well, underwriting it performing automated underwriting on it, and kind of like screening for deals this way. And then also pulling off market apartment buildings, modeling which ones have more potential, and kind of pursuing those owners only. So the way you do that is by rental listings data. It's a very data-driven approach on the off market apartment complexes side as well. On the market side, kind of like statistical regression analysis for which markets are likely to appreciate, and also downside risk. So one thing that you're very familiar with, Prashant, I think that we've spoken before, is market valuation. So that is pretty unique. So the main way I pick markets now is by market valuation, and not where population growth, income growth, like what other syndicators are mainly doing. It is a good approach during the growth stage of the market cycle. And it is a terrible approach as you go further into the market towards when the market cycle shifts, potentially, such as if we do have a recession or the already happening downside that we're seeing in Western and some Southern markets. And so that's another one. Then machine learning is like a fourth pillar, automated valuation models. So automated valuation models to your audience, those are things like Zillow's estimate. So Zillow's estimate, like how can you price homes or price properties and so forth. So that's something I have done to kind of discover inefficiencies and kind of find undervalued properties when I was doing residential investing, and I've converged to apartment complexes right now. And then machine learning, the two main applications of machine learning in real estate. So on the textual side, on the language side, like many of the people who are now following like ChatGPT and all that, those great developments indeed, and a little bit hype, but also great developments, is natural language processing is extremely useful for screening deals and for trying to find deals on the text classification side. So I've been doing that for some time, where if you need to screen through let's say 1,000 deals, you can do like classifiers and use machine learning to classify what conditions the text behind those deals, the description of those deals is presenting that property to be, and kind of scoring them, let's say 1 to 5, like condition scoring. So that feeds like automated valuation models. It also feeds automated underwriting. And then on the image side, there's a company in New York City, for instance, called Foxy AI, that they do like condition scoring for real estate images. And so if some of you guys know, like Vin Vomero is the name of their founder. And so that is another aspect that is via like computer vision that is very useful, because you can have those screened and you don't need like to have like multiple analysts to do it. And with the development of ChatGPT, it's really based off a large language model in machine learning. So with the development of large language models, it actually becomes like, how to say, like it has a huge application to the commercial and like real estate investing underwriting field, where you would pay for analysts to underwrite deals and like pay them, let's say, like high salaries to do that. But as that goes on and develops, like what seems to be perhaps the future is actually to have a model trained on the specific underwriting that the specific company did, and then be able to perform it according to the taste and liking and approach that company's analysts are underwriting it. And then, okay, then that becomes a question where, okay, that's already automated. And so that's really what data-driven investing is. So it's a very different, kind of more rigorous approach where you do try to automate a lot of those aspects. There is also social media, that social media is useful. So one thing that I do is I haven't utilized it enough, but I've been doing it for some time now, is actually pulling from Facebook groups all the different posts and using machine learning, NLP, natural language processing algorithms to classify which ones are actually selling a commercial multifamily building or apartment building. And so that is a way you can think of how much that could scale. If you think of a situation where you can be looking at a single screen for every post, and now suddenly you can have, let's say, like thousands of those kind of processes at a time, and then you can just pass them to your acquisitions analysts, and they can kind of like, okay, then review those deals and like code the respective agent or person, whoever like is posting that deal off market, or whoever it is, or it could be a wholesaler too, but whoever is posting that deal on social media. So again, it's a different mindset. So that's what I'm trying to say. Mostly to a passive investor, that is a mindset that they want to seek, or they might want to seek in the operator that they invest in. A part that is extremely useful to a passive investor from data-driven investing, that I would say they have bigger capacity for it than even operators, is picking markets. Operators, they're tied to their market. They're not so flexible, in moving like to all those different markets and so forth. Passive investors, just like larger funds, they can pick deals in the right markets. And so that's where like knowing market valuation and doing statistical studies to actually understand which markets are not overvalued right now is extremely useful to a passive investor, because I feel that passive investors at the current time ought to, or it's reasonable to invest in under fairly valued markets. It can carry a very low recession risk, and those markets tend to outperform appreciation-wise over a decade ahead. And so those are again like just like some of the bullet points, like about like six different items, like automated underwriting for on the market, like off market, commercial modeling, statistical regressions for market side, valuation models for properties like AVM, like Zillow's estimate, and then natural language processing, computer vision for some of the pieces that feed that. And I can say what I view as kind of not, what is maybe not data-driven, that perhaps can be confused to be data-driven in a way, or how to say, can kind of do some discussion on that. Go ahead, Prashant.
So my next question is, I want to basically understand from a passive investor standpoint, how can you provide some data or the guidance regarding the off-market and on-market deals, and evaluate the market also and provide that information, maybe in a simpler format, or maybe provide that information, on a portal so that people can be benefited by that?
Yeah, that's a great question. So on the market side, that's something that I already have. So it's realtyquant.com. If they go, so we have the data for like 3,000 US counties on basically which US counties and metro areas and states are over or undervalued. So this is kind of fairly easy. Like this is just so readily available data. So let's say you would look at perhaps, let's say Tampa, Florida, and say, let's say Tampa, Florida is perhaps 43% overvalued or something like that off the top of my head. And then you would have like a forecast for, okay, a mild recession decline that could occur just as your kind of risk management, like downside risk. Mild recession decline that could occur in the market of this valuation level, and then a severe recession decline that could occur in a market of this level. And so that is just available kind of to anyone to utilize without having any skill set or having to derive it themselves or do anything like that. As far as the property analytics, they're more geared to, admittedly kind of active investors where, okay, they would use, so we have reports for different cities. So let's say like place like kind of Indianapolis and so forth, and we have the inventories in those cities and kind of model it on what rental upside and income upside and expense upside some of those apartment complexes have. So basically, our algorithm uses rental listings data, like I mentioned, and underwrites off-market buildings. I think I've shown you that one, Prashant, some time ago. Underwrites off-market buildings on those components. And so rental listings data gets provided by like different vendors and like Datafinity and so on and so forth. And it gets aggregated and it can come from like different sources. I mean, but from there, it's just a very useful insight. So that is what is useful to investors, because investors, they can take those off-market inventories and then they can go to their CoStar and they can make phone calls to just the top 20% buildings in that market. And they kind of not waste time with the other 80% that either way don't have any upside, because their rents are not below market. Their other income and expenses, et cetera, are utilized compared to the immediate neighborhood and property costs and so forth. And so they're not really showing any upside. So perhaps not so productive to actually be spending time on them as far as an off-market pursuit of sort is in terms of like phone calls to owners and so forth. And so that is for active investors. But passive investors, the real value is, I feel, is kind of being a Warren Buffett of real estate investing, where you can be purchasing undervalued markets. And being a passive investor, you have the full power to do that. You can just pick deals wherever you want. You can pick deals in the Midwest, you can pick deals in the South, you can pick deals in Arizona if you want, wherever you want, pretty much, as long as you know sponsors in those markets. And so passive investors have the freedom and to pick the right markets right now. And that's where RealtyQuant, so realtyquant.com, again, like data, the market side is very useful.
So let me jump in there, Stefan,
Yeah,
so just to understand a little bit more. So you are there, you're doing this high level data analysis, and you are kind of finding out pretty much seeing what property is going to be best in terms of maybe returns or whatever after you go through the whole gamut of it. Now, after you determine a certain property or properties from your analysis, are you syndicating those? Are you the operator for those? Or you have operators, you pass those off to where the passive investor is able to come in and invest in those deals? Can you explain that a little bit more?
Correct. Yes. So I've switched from doing like condo conversion residential projects by New York City before to doing commercial multifamily, kind of what perhaps you guys are doing, but with a little bit smaller complexes for my side. So now I'm focusing on like around 50 unit apartment complexes that have value add and offering those to investors. So so now working on my third apartment complex and kind of keep seeking for new ones and trying to execute more and more of them. So so definitely offering those to investors is the current focus.
Have you thought about offering the service? I know we may discuss it once. Have you thought about offering what you offer as a service or a subscription service to a normal public. I mean, this sounds like a great value that you provide. I mean, you have that data, you have, I mean, tell us your
Yes.
thought, how can people be benefited by this? I know there's a lot of knowledge that you have. So how can folks,
I understand. That's a great question. Yeah. So if they go to realtyquant.com/analytics, so they would see basically they would be able to purchase if they want or whatever. I mean, it's not a sales pitch, but they could purchase the data for every market in the US as far as the market data. So that is available. So those are like reports that they can purchase for different markets. So that is the value that I kind of provide for investors, and whoever wants to, like syndicators, buy it from me and so forth. Now, the real value though, I feel for the industry of those type of data is at the institutional level. And that's where I recently started, I haven't had sufficient time. I recently started to actually speak to the lending industry, which they have a more material interest in like which markets are overvalued, because they use it for like loan to value adjustments. And so yes, so investors, they can absolutely, I think they should get familiar one way or another with some of the data that we have, because I think it is pretty unique and it will help them, guide them as investing now ahead of a recession. And it's pretty different from what the outcomes that they would get otherwise if they follow like the usual like syndicator advice, if you will. So I think they should get one way or another familiar with that data. They can also follow me on LinkedIn or like look at like some of the articles I've put at realtyquant.com. But yes, it is available for them as far as for active investors, the apartment complexes modeling, it is also available as a product at our website as well. So again, at realtyquant.com/analytics. So there's like commercial multifamily lead generation data, and that I think currently is for 100 cities. So 100 cities, you get like all apartment complexes in each city, and ranked according to which ones are at the top of actually the ones that show more value add. And then you can give them to your analysts to make phone calls or do whatever with those apartment complexes. But it's a different approach than I guess what we would get from like Prospect Now or others, because you actually have them modeled. So it's kind of like slightly different, more information than you would receive from that. So it is available, but also like to your question, I feel like it's mostly useful to the market side, is mostly useful to passive investors, because they have some syndicators who purchase that data, but they're mostly because they just know me. So they know me personally, maybe like the way I would come here, like to this podcast and so forth. And so they use it, but do they modify their decision so much on it? I'm not sure, because they're still tied to their market. They kind of keep buying in that same market. Now, while a passive investor, if you can greatly benefit much more, because they can just say, okay, I'm going to stop investing with sponsors in Phoenix, Arizona. I'm going to be investing now in the Midwest, because I feel, because now I learned from this data, this is where it's safer to invest ahead of a recession and so forth. And they can just fully pivot and they can decide, okay, I'm going to invest there, and like it can take them a couple of weeks to build some of the sponsor relationships in those markets, but they can still build those relationships and pursue it. So yes, passive investors, absolutely. I think they should one way or another get familiar with the data that we have at realtyquant.com or reach to me, because I think it is big value for them for sure ahead of a recession.
And I just want to make sure that our audience is getting the website right. So that's REALTYONE, Realty One.
Realty Quant, QUANT.
QUANT. Okay, so that's realtyquant.com. Got it.
Yep.
So, I mean, I understand your point, Stefan, but I want to understand, one thing is producing that data, whether the data has worked in past or not. I mean, whether the predictions driven by the data, has the data actually given the accurate prediction? Has that been proven so that, it could be taken on a face value? What are your thoughts?
Yeah. This is the best question. Right? This is the most important thing. Right? There's no point to do like any kind of data if it has no predictive power. There is no point of even looking at population trends if population turns out to have no predictive power at all, which could be, for instance, like if market cycle changes, population could end up almost breaking apart and not having much predictive power. So then you don't need to look at it at all. And so, so it's good, right? So that's what I'm trying to say. So it is all about that. So the way, so people can read like some of the articles that they have at realtyquant.com, like under like articles, I guess, tab. And so that's the way I do that is like I've gone to like every recession the past 45 years, and I was seeking for the best predictor of downside risk. So I was looking at foreclosure rates, I was looking at volatility, for example, and like this kind of like price metrics, like risk-adjusted returns, kind of like what is like called Sharpe ratio in finance, and like things like this. And okay, what is your best predictor? It's a leading indicator of then the downside that is going to happen, and to what correlation, to what predictive power. And so what I found is the deviation from fundamentals, where fundamentals you can cover income, population, and housing supply, broadly speaking. Fundamentals for the housing market are income, population, and housing supply. And so any price deviation from those, from where prices ought to be based on income, population, housing supply, proved to be the strongest predictor of downside risk following a recession for 3 recessions in the past 40 years, which are like basically like all recessions that had like any material impact. And so those, and what were those results? So if you take metro areas, let's say we take the global financial crisis, you take metro areas, and you use our data, use Realty Quant, what predictive power are you going to have as a passive investor? Why does it matter? Like you would have at metro areas, it's almost scientific, like the 90% correlation. Like the markets that were, if you invested ahead of global financial crisis, you use like data, you use simple deviation from fundamentals, you would have like 90% correlation. So it's almost scientific at the metro areas. So you get all the undervalued metro areas not really decline much. You get all the overvalued metro areas decline quite a bit. Now, as you go further, then if you go to states, let's say US states, correlation is in the 80%. So it's like around of the order of 85%. Now, if you go to counties level, and again, this is correlation like forecasting the future. There's no like kind of like false regression of sort that is like distorting. It's sort of like literally something, a data point that is today and what happens over 4 to 6 years after, actually, because declines took like 4 to 6 years generally following recessions. And so, so then you go to the counties level and that correlation now starts declining. It's harder and harder to predict as you go to smaller geographies. You go to the counties level, that correlation is now in the 70%, is around 75%. Now, it's still useful because you would have to a 75% correlation, got in the markets right. You wouldn't have it perfect, but it sort of helped in your investing if you have a portfolio and splitting around and so forth. And as you go to the zip code level, I do not have it computed. As I don't compute zip codes at every geography. It's just too much work, I would say. But at the zip code level, then that correlation would, my intuitions would drop probably in the 50% or 60s, 50% or so. So it's harder and harder to predict those. So yes, predictive power is extremely important. So the answer to that is if people pick metro areas according to this data, it's extremely predictive. It's like very, very high predictive power. Now, there's a caveat to that is happening right now. This is a pretty unique event, but it wasn't there the previous recessions. This is suburban trend. This is a suburban trend. Suburban trend is a huge thing because suburban trend is like the equivalent of internationalization of labor in the 50s. It's like you get cheap labor in China, and now you can outsource, and now you lose tons of jobs and like population outfall, like due to manufacturing jobs in certain markets. Okay, but now it's suburban trend is essentially having the same thing, but with white collar jobs, like jobs that are very high paid. And that is where that is bringing a difference now. And now we're seeing like several markets that are actually undervalued, which are declining. But those are the markets that are San Jose and San Francisco, notably, that are having like 10% of their like white collar, high income earning population just leave that city. And even though it's undervalued, versus fundamentals, its fundamentals are declining significantly. And so its fundamentals are crashing. And so that is an aspect where one needs to be looking at valuation and tracking if there's like population outflow due to suburban trend. And so, but predictive power, I think the main, so what is the main value of like Realty Quant and myself of when bringing that data at the beginning of 2020? I haven't invented it. The main value was actually calibrating it to the previous recessions to show what the predictive power was. It was calibrating.
Stefan, I think, I know you have raw data, you have created the data, and correct me if I'm wrong. I mean, if you can put together a team of people who can build algorithms around that data and put the calibration around that data and put it in a commercial format where it is needed by and it can be utilized by passive investors or utilized by retail investors or hedge funds or whosoever at a larger scale. I mean, you have great power, I mean, at your fingertips. And I'm pretty sure this kind of analytics is being done, or this kind of information is being consumed as of today by many other, passive investors and many other hedge funds. There may be other sources of similar information.
Yes, there are.
Yeah. So I mean,
there are actually, Prashant. This is a great point that you're making, and it's very interesting where, let's say, like who those sources are serving and where they really are located. Like if we take a look at like syndicators and investors, is any of them aware of like which markets are overvalued? It's like if you had like Rothcliffe, you can get the biggest real estate gurus. You can get like, let's say if you have now Rothcliffe example of like, his podcast topic of losing money following the global financial crisis by having like 1,000 single family homes in Florida, right? And kind of losing your net worth. And then on the contrary of that, I know like Vinny Chopra, he spoke at my webinar, like where he had like in the same period, the same global financial crisis, was investing though in Texas, which was undervalued. And so again, like having like any kind of like syndicators that they do not consume market valuations data, generally speaking. Like there are few now who do it through our company, but it's not generally a target. That said, the same data or similar type of data is produced by Moody's Analytics. There is a version at CoreLogic as well, and there is a version at Bloomberg Economics, and then there is a study at Florida Atlantic University. So that data is being done at the institutional level, and where it is feeding afterwards is the lending industry. So Moody's and so forth are feeding into the lending industry because they make loan-to-value adjustments, and they're going to say, okay, we do not want they make loan-to-value adjustments for companies, particularly that hold the loans, that purchase loans and hold them in their portfolio. And they're going to say, okay, we're not going to buy any loans. They can say they're not going to buy any loans in the state of Idaho, for instance, which was like one example that I became familiar with, or we're not going to buy loans in specific neighborhoods in this city in Florida, because those neighborhoods are like too overhyped and so forth. And so that is where, to your question, is it done? It is done at the institutional level, and it is consumed by the lending industry. Now, by the lending industry, like I spoke to one of the loan buying companies that have like perhaps like a $9 billion portfolio, so one of the bigger ones. And it's interesting that their consumption of it is actually still relatively limited. So they would have like few markets, and they have some metrics for those, and they haven't gone too deep. But are they using it? Yes, they are. Are any investors using it? Almost nobody. It's like, and it is funny because investors, to me, I feel like even though they are like geographically focused, I feel they still should be aware and should be using it, because, I personally, I don't want to like be investing in something that I know is doomed for the next 10 years just because I'm buying it at a 50% overvaluation. And so, but this is an extremely great question. The answer to that is like the real market that I see like for the future for us is really in the institutional and the lending industry space.
Awesome.
Now, I was just thinking that
Mhm.
you have a great thing that you have at hand there. I mean, Prashant just make mention of that, but it just seems
Mhm.
like we have to find or not, maybe you have to find a way to kind of get it where the regular guy on the street can kind of use it, right? Whether the passive investor, so they can kind of find, what geographic location to invest in, that type of a thing. It just looked like it's something great, but how can we get it into the hands of folks who can use it in a layman's term, and make a good decision about their investment? I
No,
think
Paul,
that would be very helpful.
right. No. Passive investors, they can now use it very easily by realtyquant.com. They would just get like a number. This market is like 40% overvalued, and they would get other metrics on that number. So to passive investors, this is really available in an easy form, because it's just like, oh, what is easier than having a number? Like, this number is what's driving everything for you. Where it's like more interesting question is like, like we discussed, like some of the institutional integrations, if you will. But passive investors, they do, that is something that they do have available, and they do use it. And investors, active investors do use it. Like, I have like active investors who, they use our data and, purchase our data. But again, is this like a big market where that provides the biggest economic value? Probably not. It would be something that is very much at the institutional level. I feel because they just have a different perspective, and they kind of care more, like, and even passive investors, even though they can diversify a lot, it depends on their relationships. They kind of trust their sponsor, and they're thinking, okay, my sponsor has done their due diligence, and they don't know that their sponsor has not done any market due diligence of something like this, because their sponsors virtually don't know this thing.
Right.
And so
this is awesome. This is awesome information. I mean, passive investors definitely can go to realtyquant.com to learn more about the data that you provide, and you talk freely. Discuss this again and again, multiple times. But to your point, at the institutional level, maybe this data can be commercialized and put to use. I mean, you are talking about, you are from, a Cornell in finance major. You have produced something which is not being utilized too much. Which I personally feel, and that is something maybe we should take it offline and discuss it, how we can kind of put this thing together, package it together, and bring it to the market. But all in all, I just want to say thank you, Stefan, for your time today. Your insights have always been very helpful. The important thing is, passive investors should understand that there is a lot of information available, and a lot of brain power has been used to produce, to give you the markets, where you can buy. I mean, you can potentially buy the data and then do the, do your own campaigns and search for your own properties just by buying this small piece of data. And make a business out of it. If I were you, I would just buy your data and put 5 guys, start calling those properties and start buying those properties like left and right. I mean, if I know that these are the markets which are going to be stable, and potentially I could find a value add opportunities in those markets at a lower scale. I mean, I don't want to go into 200 plus units, but if it is anything below 100 units, I mean, I feel like that there's a lot of opportunity for, small time, mid-size operators. So how can anybody reach out to you? I mean, what's your contact information, Stefan?
Yes, absolutely. Yeah. And thanks, Prashant. So if I may add, like, to your point, I do feel that, I do feel exactly like you mentioned, that passive investors, based off at least my kind of studies of this, just my perspective is I feel like it's very beneficial if they invested in under and fair developed markets ahead of recession. The only way they can actually get that for many different markets anywhere in the US is that I know of is really realtyquant.com. The other way is they have to have like a huge subscription for tens of thousands of dollars at Moody's, and then get it in some way. And I'm not even sure how you get it then, actually, because you know some people who are signed up, and I don't think that that's available. But as far as so definitely, like, pick your sponsors wisely according to their skill with their property, but use our data and select sponsors in those markets that don't filter very high. Because even if you very high, it's very overvalued. Because even if you pick your skilled sponsors as a passive investor, the market side could take it away for you. And we've been seeing that already, like with Austin and Boise and Phoenix being down like 8-9% since the peak already at this point in terms of their housing markets. And commercial multifamily, okay, it's different valuation approach and so on and so forth, but really highly correlated. And so from that perspective, yes, so passive investors, pick your sponsors that you have a relationship with, that you know well, that are strong operators, and you execute the property side of your deal, but use a filter through market data such as RealtyQuant, where you would actually not be in the wrong markets with those right sponsors, but in the wrong markets as we enter a recession. And so that is where I think it's very important and very, very, very useful to them. And so, yeah, the best way to reach to me, again, it's the website, realtyquant.com, and people can find me on LinkedIn as well, Stefan Tsvetkov from LinkedIn.
Thank you so much, Stefan. This is just really amazing.
Thanks
for breaking it down the way you do. Really appreciate what you do. Thanks for coming on the show today.
Thank you.
Thank you so much, Stefan.
Thank you for tuning in to this week's episode of the Cash Flow Champs podcast. Cash Flow Champs partners with busy working professionals and entrepreneurs that want to build and maintain generational wealth through real estate. Visit cashflowchamps.com to learn more about us